Welcome back. Well, as promised, let's focus on the sector of the last few days. The capital goods stocks, well, they are led by Thermax, Hitachi Energy. All of them have seen a big correction in the last couple of trading sessions. This after the union budget announcements and the revision in the capex targets that seemed to have disappointed the street and got them a little bit jittery. To talk about the capital goods space, how to approach it going ahead, well, we're joined by Pulkit Patni, the India Industrials Analyst at Goldman Sachs. Hi, Pulkit. Good morning, and thanks a lot for joining in, Pulkit. The street is clearly very, very jittery with regard to this capex number. One would argue the last few years, the capex expenditure has been much higher than the 10% growth that they're talking about right now. What is your initial take on it?
Good morning, and thank you for having me. No, it's a fair point. I think market expectations were running ahead of what the government could deliver. For the last few years, while capex growth was significantly higher, I think one has to appreciate it came in with significant higher revenue numbers also for the government. And our base case estimate was that it will start aligning with nominal GDP, which is exactly what we've seen come out this year. I think it's also fair to expect that this is going to be the trajectory going forward in terms of what the government can spend on capex. I think what the market is missing out right now is that at least on a sequential basis, especially the way the December number on capex came out, you're likely to see some very strong months in terms of government capex number, i.e. it will also reflect an order influx of some of these companies. So while the correction has been quite stark, a lot of that is reflecting the excesses that got built in some of these valuations, and you are seeing that correct. But in certain cases, it could actually provide some opportunity in the near term because we expect that the near-term numbers in terms of quarterly order inflows may actually be pretty good, at least for the next couple of quarters.
Yeah, Pulkit, morning. That's a great point, actually. Yes, and in the whole buzz of the budget kind of got missed that let's not forget that the FY25 numbers still have to meet the RE, right? So they still have to spend to, finish up the business for this year. So great point. Now, my question is that it's very clear that, this is no longer about defense expenditure going up by this much, so you buy defense stocks, or railway expenditure going up by this much, so you buy railway stocks. That became a bit of a no-brainer trade, over the last 12 months or so. What is the new nuanced approach that you will take to capex, industrials, and capital goods stocks? Because they are spending in different ways and means, right? There is this consumption boost that's come in, so people will spend more on I don't know, they'll travel more or, you'll need more hotels or whatever it might be. So how else do you play? And those hotels still need cement and steel to be made, right? Then there's some talk about nuclear, etc. So what is the new way of playing capex?
No, absolutely. I think the approach has to be a lot more calibrated based on sectors where there's going to be more spending. So, for example, we think cables and wires is one sector which plays into the capex theme, but has its own fundamental growth drivers. One is the real estate cycle, where whatever has been launched gets into construction phase. You've got a reasonably strong power cycle, and I don't think that cycle is going to be a short one. So you should expect announcement both on generation and transmission to be more long dated, as well as the intensity of cable that is getting used in infrastructure is actually a lot higher. So we think one of the ways you could play the capex theme is through the cables and wire sector. Similarly, as you rightly highlighted, I think durables is one sector where there's been quite a lot of softness. With this push that has come in terms of income tax benefit, we think that's another sector of a low base which could actually go on to benefit in the medium term when it comes to the entire demand cycle. And then there are certain small themes, for example, pipes, where again, you had a weak demand. But if you look at the allocation that has happened to Jal Jeevan Mission on what was actually spent in FY25, that number could also see pretty significant growth. So absolutely, there are parts where there is a reason to be finding optimistic numbers as well.
On the pipe space, how do you play it? If you could name a few companies that have exposure to the ductile pipes business or the smaller pipes, or how do you play this theme?
We're talking about the PVC pipe space, PVC, UPVC, which go into the construction phase. We'll typically stay away from talking about specific names, but these are the construction-linked plastic pipe companies.
Pulkit, hi, morning. Prashant here. So just 2 points. One is, we had Rahul Chadda, formerly of Mirai and now Shikara, telling us in the morning that an opportunity will appear in the industrials capex-related plays, maybe March, April. And he said, not my words, his words, hopefully 15-20% lower. Now, very difficult to time these things, but if you want to take a shot at that. And number two, if you can talk to us a little bit about valuations here. Because, now, I mean, just using this as an example, take CG Power, right? Was trading at 80, 90 times. It's come off sharply. It's now about 50, 55 times. I'm talking about 1 year forward P multiples. And I think similar would be the case with many others which have corrected. Now, is that fine? It's all relative in markets, but it's still high, right? I mean, but what's the right P multiple here, in your opinion, for the space as such, not for a stock? Go on.
Sure. No, absolutely. I think when we say about excesses, we refer to valuations that were expecting very strong growth in these companies for a sustainable long period. Now, I think as these valuations correct, they will eventually align with what kind of growth these companies can deliver, because I don't think the path of growth in the capex cycle has really deviated. I think it's, as I highlighted, it's just realigned itself to nominal GDP growth number. And if you were to pencil in those kind of growth numbers and order inflow of these companies, then possibly at some stage with some correction, you're absolutely right that valuations will start aligning because the growth path for these companies continue. So while again, I would not want to time it, and it's always very difficult how markets react to these things, but it is basically, it will get to a stage where some of these themes start looking interesting. I think the other thing that you also have to factor in is that there are themes within themes, right? While we speak about defense, we also have to appreciate that even if the overall allocation to defense has not gone up, the indigenization theme in defense is something that is going to be there. So you're going to see domestic companies who will continue to gain market share. And that's why there are industrial companies where it's going to be more about market share gain from their global peers rather than the absolute capex growth number that the market is so aligned to at this stage.
Okay. So just to press on that point further, Pulkit, if we talk about sane valuations, you described a lot of different segments, right? You described pipe companies, cables and wires, and maybe in some parts defense as well. So which of the capital goods or industrial segments are now reaching sane valuation zone or close to sane, let's say?
I mean, there's still some time before valuations align to what you would call as long-term median multiples. In most cases, they're still significantly above one standard deviation. But as I said, that themes like defense, like power, where we have visibility that the next 3 to 4 years of order inflow growth should be good, is where I think markets will start catching on to the fastest. Valuations still have further room to correct if you were to look at on a long-term basis.
All right. Got that. Valuations have more room to correct on a long-term basis. They have to align themselves with capex growth, which is now in line with the nominal GDP growth, which is about 10% or so, as Pulkit is pointing out. Thank you very much, Pulkit. Appreciate you joining in, and good conversation, good perspective there. We'll take a